Bitcoin keeps sliding, not slowly, not quietly, but with enough force to shake confidence across global markets. 6% gone in hours, Ethereum falling even harder. And suddenly, the question is no longer about numbers. It is about timing, about risk, and about what the market might be warning everyone about. Geopolitical tension rises. Investors step back. History begins to repeat patterns many thought were finished. Some believe this is just another dip. Others feel something deeper is changing beneath the surface. Because when confidence fades, markets rarely speak loudly. They whisper first. And right now, that whisper feels unusually heavy. Welcome to Boring Currency Index, a place where markets are explained calmly, not loudly. If you have seen markets rise and fall over the years, consider subscribing to the channel. Not for hype, but for clear thinking. And tell us in the comments, from which country are you watching today? The market opened with quiet pressure already building. Bitcoin slipped under the $80,000 level, losing around 6%, while Ethereum dropped even faster. Traders did not rush into panic. They watched the numbers carefully, trying to understand if this was a normal correction or the start of a wider shift. Liquidity became thinner as prices moved lower. Large sell orders pushed the market down more quickly because fewer buyers were ready to step in. Institutional traders focused on data instead of emotion. Some reduced exposure slowly, choosing safety, while others waited for signs of stability. Entrepreneurs observing the situation started asking practical questions. If digital assets could move this fast, how should businesses plan for risk? Startup founders who depended on strong crypto sentiment began to rethink funding expectations. Capital started moving towards safer positions, showing a clear change in confidence. Historical comparisons appeared again. Similar declines had happened before, yet each one carried a different message. This time, the real signal was not just the percentage drop, it was the timing. A reminder that markets often react to deeper forces long before the full story becomes visible. The market decline did not happen in isolation. Beneath the falling prices, a deeper tension was already shaping investor behavior. Rising geopolitical unease, especially between Iran and Western powers, quietly altered how risk was measured. When political pressure increases, financial markets often respond before headlines fully explain the reasons. This time was no different. They understood that global capital moves on trust. When that trust weakens, investors reduce exposure to assets considered non-essential or speculative. Cryptocurrencies, despite their technological promise, still sit in this high-risk category for many institutions. As uncertainty grows, money tends to flow towards stability rather than innovation. He noticed that this pattern had appeared many times before. During moments of geopolitical stress, markets rarely wait for outcomes. They react to possibilities. Even without direct economic sanctions or policy changes, the fear of disruption alone is enough to change investment behavior. Traders begin to price in worst-case scenarios long before they become reality. Historical context added weight to the current situation. Previous episodes of global tension had triggered similar sell-offs across equities, commodities, and digital assets. In those moments, investors questioned which assets truly protect value during conflict. Crypto, once seen by some as a hedge against traditional systems, increasingly behaved like a technology-driven risk asset instead. At the same time, memories of past economic shocks resurfaced. Trade disputes, tariffs, and sudden policy shifts had already taught markets how quickly conditions could change. These experiences made investors more sensitive. They no longer waited for confirmation. They acted early, often at the first sign of instability. For business leaders, this environment created difficult decisions. Expansion plans slowed. Capital preservation became more important than aggressive growth. They watched global developments closely, knowing that political events far from their operations could still influence funding, currency values, and investor confidence. The crypto decline became a reflection of something larger. It showed how interconnected modern markets had become. A regional political issue could ripple through digital exchanges within minutes. The price movement was not just a reaction to fear, it was a response to uncertainty itself. As Part 2 reveals, the fall in Bitcoin was less about technology and more about trust. And when trust becomes fragile, markets send warnings long before clarity returns. While headlines focused on falling prices, the real movement was happening beneath the surface. Large institutions did not react the same way as retail traders. They rarely chased sudden drops. Instead, they adjusted quietly, changing exposure through complex strategies that most observers never saw. They monitored derivatives markets closely. When Bitcoin slipped under key levels, automated systems began to trigger liquidations. These forced sales pushed prices lower, not because investors lost faith overnight, but because leverage had reached a fragile point. The market moved like a chain reaction, where one liquidation led to another, accelerating the decline. He noticed that liquidity providers stepped back during the most volatile moments. This created wider price gaps, making each trade more powerful than usual. for institutional funds, this was not chaos, it was a predictable pattern. Volatility often reveals where the market is overextended. By studying order flow and trading volumes, they searched for signals of exhaustion rather than panic. Another factor shaping the decline was risk management models. When geopolitical uncertainty rises, many funds automatically reduce positions in assets labeled as high volatility. This process happens through algorithms rather than emotional decisions. The result is a steady withdrawal of capital that can look like a sudden crash from the outside. Entrepreneurs observing these moves began to understand a deeper lesson. Market prices are not driven only by news or public sentiment. They are influenced by invisible rules built into financial systems. When those rules activate, even strong narratives struggle to hold prices in place. At the same time, some institutions viewed the drop as an opportunity. They waited for signs that selling pressure was weakening. Long-term investors rarely enter during moments of peak fear. They prefer periods when volatility begins to stabilize. This patience often separates strategic capital from speculative trading. The structure of the market itself revealed an important warning. Heavy reliance on leverage and fast-moving algorithms can turn small shifts into large declines. For business leaders, this offered a clear parallel. Systems designed for efficiency can also amplify risk if not managed carefully. By the end of this phase, it became clear that the crash was not simply about buyers and sellers arguing over value. It was a demonstration of how modern financial mechanics operate under pressure. And for those watching closely, the behavior of institutions hinted that the next phase of the market would depend less on emotion and more on calculated strategy. As the market settled into uncertainty, attention shifted from price charts to long-term strategy. Entrepreneurs and investors began asking a different question. Instead of wondering when Bitcoin would recover, they focused on what this volatility revealed about the broader economic environment. They understood that sudden declines change how capital flows. Venture funding often slows when risk assets lose momentum, not because innovation disappears, but because investors become more selective. Startups connected to digital assets felt this shift quickly. Funding conversations grew more cautious, and valuation expectations began to adjust to a more conservative outlook. He observed that experienced business leaders rarely interpret market drops as isolated events. They treat them as signals. A 6% decline might appear small compared to past crashes, yet the timing, during geopolitical tension and global uncertainty, suggested deeper caution was spreading across financial systems. Companies that relied heavily on optimistic market conditions started reviewing their plans. Risk management became the central theme. Instead of chasing rapid expansion, many founders prioritized stability. They reviewed cash reserves, operational costs, and exposure to volatile assets. This shift did not mean abandoning growth. It meant preparing for scenarios where funding cycles became slower and investor confidence took longer to return. Scenario planning gained importance. Some analysts believed the market could stabilize if geopolitical fears eased and institutional demand returned. Others warned of extended consolidation, where prices move sideways while investors wait for clearer economic direction. Each possibility required a different strategy. Businesses that prepared for multiple outcomes appeared more resilient than those depending on a single bullish narrative. The crypto market also served as a mirror for broader financial behavior. When uncertainty rises, innovation often continues quietly while speculation fades. For young entrepreneurs, this period offered an opportunity to focus on fundamentals rather than hype. Strong business models, clear revenue paths, and disciplined financial planning became more valuable than rapid price growth. They realized that volatility itself carries information. It shows where confidence is strong and where it begins to weaken. Leaders who paid attention to these signals could adjust early, avoiding reactive decisions later. The lesson was not to fear market declines, but to understand what they reveal about risk, timing, and strategic positioning. By the end of Part 4, the story moved beyond a single cryptocurrency drop. It became a broader economic warning. Markets were not just fluctuating, they were testing how prepared decision makers were for an environment where uncertainty could remain longer than expected.